another tutorial video. This time we're going to be looking at an LBO modeling test. As you can see here, this is based on a real test that was given at an assessment center in Europe a couple of years ago and was also actually given to an incoming class of investment banking interns. They had to complete it at the end of the internship. From what I hear, none of them actually managed to finish it successfully. So we're going to go through this and teach you how to actually answer all these questions and finish it successfully. Now, this case study, as you can see from the accompanying Excel file, is quite a bit more involved than something really simple, such as a so-called paper LBO case where you just have to estimate a few numbers and get to the IRR and the cash-on-cash multiple. Since this is more involved, we're going to split this into two separate tutorials. And in the first one, we're going to go through how you take the assumptions for the financial information for the company, as well as the transaction and the capital structure, and how you set up the LBO model, the income statement, the cash flow statement, and then tracking the debt balances, interest expense, and calculating investor returns. And then in part two, we will focus more on the interpretation and looking at the sensitivity tables and going through and answering all these case study questions. Now, when you get a case study or an exercise like this, you might be tempted to jump into Excel at first and instantly start trying to type numbers and formulas. But the first thing that you really have to do is read through it and then decide on your strategy and how you're going to actually approach this. Now, I'm not going to read this document because you can download it below the video and look at it yourself. But essentially here, they're saying that we have to calculate the cash-on-cash multiple and IRR, and we have to assume that the company is purchased and then the PE firm exits under both a traditional M&A exit, a sale to another company, and then an IPO exit where they take the company public. They're also telling us that the model has to be well formatted and easy to understand, which is why it looks like it does here. And they're also saying that we should include sensitivity tables. So we have some information from that. And then they're giving us the company's financial information, their revenue and EBITDA, 200 million revenue, 50 million in EBITDA, both in euros. They're telling us to assume certain growth rates and margins going forward. And they're even giving us the information for the taxes and cash flow items like depreciation, amortization, capital expenditures, and even how some of these balance sheet items change or what percent of sales they represent. To save some time, I've already entered all these into our assumptions up here. For the purchase and exit, they're doing a few tricky things here. First off, they're not telling us the actual purchase price for the company. They're saying that we're going to have to solve for the EBITDA purchase multiple in this case. They are telling us to assume an 8x exit multiple in the base case. They're telling us there is no management rollover or management equity, so that simplifies things. And then they're giving us the fees, the M&A advisory fee for the bankers working on this deal, the financing fee for the debt, and then the sponsor fee on the purchase price. We have the debt assumptions here. Notice how they're not giving us a specific percentage of debt. These are all multiples of LTM EBITDA. The first three, the term loans amortize over 5 years. Interest rates are tied to LIBOR. And then the second lien and paid in kind loans both have fixed interest and effectively have bullet repayment with no optional repayments and no amortization. So we have a lot of these assumptions. Now, reading through the rest of this, we can see that there's a big focus on 3-year periods. We have a 3-year period in question number 1. And then in question number 2, we also have a 3-year period. And they're asking us some questions about how different multiples and different margins impact these numbers. And then even in question 5, we still have that 3-year period. And in question 6, which is about the IPO exit, here it still happens in 3 years. And we do have to go 1 year beyond that. But based on all this, we can be pretty certain that we only need 3 years of projections, which also simplifies things a bit and saves us some time here. Based on this, the first thing that you should do is decide on your strategy. So a couple things to note from this exercise. First off, if they give you this and say something like you have 30 minutes to complete this, in my opinion, there's no real way to do that. You're going to have to either cut corners or take more time. The only way that you could really do that is if they already give you everything here and you don't have to do any of the formatting. You're starting with more than a blank sheet in Excel. Otherwise, I don't really think it's possible. In some cases, they will try to scare you by giving an extreme time limit like this. If that happens, finish what you can, skip the formatting, and simplify and cut corners whenever it's possible. Also, as I just mentioned, notice how only 3 years of projections are actually required here, which saves us time. If you really sit back and think about it, you can also figure out that we're not going to need to create a very complicated debt schedule, because look at, going back to the Word document here, look at what they're telling us. Within the model, assume that excess cash is not used to repay debt and instead simply accumulates on the balance sheet. Now, the reason the debt schedule usually gets complicated is when you have optional debt repayments, and the company can repay some of the debt but not all of it with its excess cash flow. If you don't have that option, it makes your life a whole lot easier. And remember, we only have 3 tranches of debt here that actually amortize. So we can probably just hard code these numbers on the cash flow statement and be fine. We don't even have to worry about the second lien or the PIK loans here because they simply do not amortize and they cannot be repaid optionally. Also notice how there is no real balance sheet required. Now in the assumptions, yes, they are giving us some of these numbers like inventory, receivables, and payables as a percent of sales, but remember, all we really have to do is figure out the cash flow impact of those items. So if inventory goes up, that's going to reduce our cash flow. If receivables go up, that's also going to reduce our cash flow. And if payables go up, that is going to increase our cash flow. So as long as we can reflect that and tie these to the change in revenue, we don't need a full balance sheet. We will have to keep track of the different tranches of debt and how they change over time, but that's about all we need to do here. And then also to save some time, we're going to consolidate a lot of our assumptions along with the sources and uses schedule. Typically in an LBO model, you would split out items like the interest rates on debt and the fee percentages and show these separately, and also have a separate area for the sources and uses schedule. Here, we just don't have time, so we are consolidating and simplifying and showing all of this together. A few other tricky points to note before we get started. First off, we do need to make an assumption for the purchase EBITDA multiple initially, even though the instructions told us not to, simply because the rest of the model is not going to work if we actually leave this blank. So this is a case where the instructions are deliberately deceptive and we have to fill in something there. Next, the IPO exit is going to require more of an actual investor returns area in our Excel file. So if you go down here, to really save time, potentially we could just eliminate all of this and we could just calculate the IRR and the cash on cash multiple with some simple division and raising numbers to the appropriate powers. However, I kept it like this simply because when we look at the IPO exit, we're going to have something happen in year 4 because part of the stake gets sold in year 3 and part gets sold in year 4. And then finally, we have to go a little bit out of order because of the way the assumptions are given to us, and we're going to end up using goal seek quite a bit in this to figure out the appropriate purchase price and some of the other assumptions. So the recommended order for completing this is: number 1, lay out the assumptions and sources and uses schedule. Number 2, fill in the income statement. Number 3, do the cash flow statement and debt repayments. Number 4, calculate the interest expense and then link the statements as much as you can. And then number 5, set up the returns calculations and the sensitivities. We're going to stay focused mostly on the first 4 steps here, although we will calculate the returns in the end. We're going to focus more on step 5 in the next tutorial after this for part 2 of this case study. So let's go in and actually start filling this out. For the assumptions area, remember, we have to assume something for the purchase multiple, even though the instructions said not to. We have unreliable instructions that are trying to trick us in this case. So I'm going to say eat and keep it the same as the initial exit multiple here. For the purchase price, it's it's not clear whether this is the purchase equity value or the purchase enterprise value exactly. We do know, of course, that if we take EBITDA and multiply it by 8x, yes, that's going to be the purchase enterprise value. The problem is that we don't know the company's existing debt. We do know their existing cash balance, but it's tough to say what this is actually equal to. So in the absence of further information, we're just going to assume that they have to pay 8x LTM EBITDA of 50 million euros, and that is our purchase price here. Now, in the sources and uses schedule, let's link to our purchase price first. And then for the M&A fees, this is going to be a percentage of this purchase price, so let's link up there. The financing fees we cannot fill in yet, but what I can do is take our percentage and then link to the total amount of debt that we're using to fund this deal. Now, the sponsor fee part gets a bit tricky because if you think about it, if these really go to the private equity firm, it might actually boost their returns. It might actually reduce the amount that they need to contribute in some way. We don't know exactly how this works and we don't have any detail, and it's very, very small, so we're not going to worry about that. So I'm just going to multiply the 0.5% by the 400 and then add these up. We also like to look at all these as a multiple of LTM EBITDA. So I can do that, copy it down, and add those up. Now, for the rest on the sources side, we have to look at our funding sources and then back into our investor equity based on total uses of funds minus sources so far. So to do this, let's take our term loan A right here, multiply by LTM EBITDA, copy this down. And then for investor equity, let's take our total uses of funds and then subtract our sources so far, and then add this up. So we have our sources and uses schedule. It matches, sources equal uses, so that's a good sign. And now we can get started with the rest of this. Now that we have our investor equity, we know the amounts of debt that we're using, and we have our fees and other assumptions. With the income statement, we have our LTM EBITDA, and then we have our growth rate of 10% that the instructions gave us. So we can copy that across. Now EBITDA itself, we can take our revenue and multiply by the margin and copy that across. Depreciation and amortization, we'll take our revenue, multiply by D&A as a percent of revenue, copy that across. Interest we'll leave blank for now. Pre-tax income is just going to be equal to EBITDA minus the depreciation and amortization minus interest, and copy this across. Taxes is just pre-tax income times the 20% tax rate. We have that. We'll copy this across. And then net income is just our pre-tax income minus our taxes. So we have that. We have our income statement mostly set up, although the interest expense is missing. So let's move to our cash flow statement now. For the net income, we can just link to the numbers right above. Depreciation and amortization, we can link to our number up here and just flip the sign to turn this into a positive. So this is a non-cash add back now. Now, for inventory and receivables, these are both going to cost us extra and reduce our cash flow as sales go up and as these go up. So here we can just take our old revenue number, subtract the new revenue number, and then multiply by inventory as a percent of revenue. And then we can take the same formula for the receivables and just multiply by receivables as a percent of revenue. And then for payables, here we have the opposite scenario. Here, as this goes up, as revenue increases, payables go up, which actually boosts our cash flow. So I'm going to multiply by payables as a percent of revenue, and then we can copy this across as well. For CapEx, we can take our revenue up here and multiply by CapEx as a percent of revenue. Copy this across. For the free cash flow, let's just do a summation of everything above on our cash flow statement, and we have that. Now, the next part of this with the debt repayments is actually easier than you might expect, simply because there is no optional repayment. Remember, the case study instructions said to assume equal amortization over 5 years, so that actually makes this a fairly simple exercise, because all we have to say is that we take our initial term loan A balance and we divide by the amortization period. I will anchor the F part here so this doesn't shift around as we copy it around. And you can see how this is also something you could potentially simplify, because think about it. If you were really under time pressure, the amount of debt that you raise is always going to be the same. Why? Because it's always based on LTM EBITDA, and you're always assuming the same multiple of EBITDA for this debt. So if you really wanted to, you could just hard code this and say negative 30 million each year for the amortization, and you could simplify the whole rest of the treatment here as well if you wanted to do that. Now for the net change in cash, it's just going to be our free cash flow plus all the debt repayments here. Copy this across. And for the cash and debt balances, the debt balance first is just equal to everything up here. And then our cash balance is equal to our initial cash balance here of 20 million. And I listed this with a $sign for some unknown reason. I had accidentally listed that one with a $sign as well as the purchase price up here, so I just fixed both of those now in the background. Now for the cash balance, we're going to take the old number and then factor in the net change in cash. And the debt balance, we can't do anything now. So taking a look at where we are, we've just finished steps 1 through 3 actually. And now step 4, the interest expense and linking the statements. And step 5, the returns and sensitivities are next. So for step 4, here for the initial debt balances in year 0, right after the deal takes place, let's just link up here and copy all these down and add up the total debt. Now term loan A, B, and C will all amortize over time. So we can take the old number and then factor in the amortization. So these are going to change over time. Now the second lien debt has bullet maturity, so it's going to stay the same over 3 years. The paid in kind loan, I'm going to leave blank for now because with paid in kind interest, the interest accrues to the principal of the debt. So the interest here is going to directly increase our balance. We haven't calculated that yet. Now for the net interest expense, you have to be really careful here because with term loan A, for example, in a lot of LBO models, you'll take the average debt balance between, say, year 0 and year 1 to calculate this. The problem here is that later on in the case study, we are going to be using the goal seek function to answer these types of questions about the cash on cash multiple and the price that they can pay to achieve certain returns. Now, the goal seek function in Excel, if you go to Alt A W G, this does not work if you have circular references, and as a result, we are going to base our interest expense here on the beginning balance. So in other words, the ending balance from the previous year. So we'll take our term loan A balance, and then we'll go up, and term loans A through C are all tied to LIBOR. So we're going to take LIBOR and then our interest and divide by LIBOR units. And we'll also just anchor the G part of the G11 there. So we have that, and we can see that this goes down over time as the debt is repaid. If you wanted to, you could just go in quickly and check that you're making sure to link to the correct items here. We have that. Now for the second lien debt, we'll take the number here and then multiply by our interest rate of 8.25%. Anchor that again. For the paid in kind loan, we're going to take our balance in year 0, and then we're going to multiply by this 14%, and we'll anchor the G part so it doesn't shift around. And so we have that. Now the other thing we need to do now is go back and change this so that the paid in kind loan in year 1 is equal to the year 0 number plus the interest expense for the paid in kind loan. So now this is going up by that amount. Let's add up the total debt balances now as well. And then the last thing to do here is to factor in the interest earned on cash. Because remember, in the case study, they told us directly that the company earns 1.5% interest on its cash balance. So we'll take our cash balance here and then multiply by our interest earned on cash of 1.5%. We're listing this as a negative because we have net interest expense at the bottom. Since it's net, we are therefore subtracting interest income and keeping all the rest as positives. So the actual expense items here are positives. Let's add this up and copy this across. So we have this. And with that done, really the last step here is to just go back and link the interest expense in and make sure everything else is set. So for the interest expense on the income statement, we'll just use a negative sign here and go down and link it to our mini debt schedule at the bottom. Copy that across. And then remember that paid in kind interest is non-cash, so you add it back on the cash flow statement. To do this, we can just go down and link to our paid in kind loan interest right here. And so we have that set up and in place. You can see here how the cash balance actually turns negative by the end in year 3. Very unusual, but this is the type of thing that we're not going to worry about because we're under extreme time pressure in this case study. If we had more time, yes, we could build in a revolver, we could do other things, we could figure out a way to build in some type of additional borrowing to handle this, but given the time pressure, it's just not worth worrying about. So with all that in place, we're really done with our mini LBO model here. And so the last step is to look at the returns and sensitivities. We're only going to get to the returns this time around, but we'll look at the sensitivities and the case study questions in more detail next time. For the returns, we need to look at our year 3 numbers. So the year 3 EBITDA first, up here, and then our EBITDA multiple of 8x right here. That gives us an exit enterprise value of 532. And then to go from enterprise value to equity value, we subtract our total debt balance, and then we add our total remaining cash balance at the end of year 3. In this case, our investor equity is the same as our equity value because there's no management rollover, and we assume that our entire stake is sold in year 3 if we exit by selling to another company. So we have that. And then for the cash on cash multiple, we're just going to do a sum if function, and we'll sum up this entire range, F87 to K87, but we need to sum up the positive numbers first, so I'm going to enter above 0 for the criteria. And then we need to divide this by the summation of all the negative numbers. So we'll do the same thing, but set the criteria to be less than or equal to 0. And we need to add a negative sign in front. So we get a cash on cash multiple of 2.1x. IRR, we can use the built-in function to solve, and we get to an IRR of 28%. So we have our basic model set up now, but we haven't yet looked at the case study questions. We haven't yet looked at what happens in this IPO exit and what we need to change around. And we haven't seen how to use goal seek to actually solve for all these numbers that the case study questions have asked us for. So coming up next time around, we will be doing that. We'll be fleshing this out in more detail, filling out the sensitivities, and going back in and answering those case study questions.